What if the price you see on your screen right now has absolutely nothing to do with the price being paid for real silver, in the real world, at this exact moment? Not a hypothetical, not a philosophical riddle, an actual, documented, measurable gap between two numbers that are supposed to be the same number. One price on a screen in New York, another price being paid in cash, in person, at a vault in Tokyo, 80% higher, not 5%, not 10%, 80%. And that gap didn't happen in secret. It happened on January 1st, 2026, while most of the world was counting down to midnight with a drink in their hand. This is OG John AG, and what you're about to hear is not a silver price prediction. It is a forensic reconstruction of one of the most structurally alarming sequences of events in modern commodity market history, told entirely through numbers that already exist, documents already filed, fines already paid, and delivery data that anyone with a Bloomberg terminal can pull right now. We are not going to speculate our way through this. We are going to follow the data. And the data leads somewhere very specific, somewhere mainstream financial media has largely refused to go. If you've been following this channel because you believe markets deserve honest analysis, not just the analysis that's convenient, then hit that subscribe button and keep this conversation going. The next 20 minutes will change how you read every silver price chart you ever see again. Let's start with the number that changes everything, not 121. Not $75. The number that actually matters here is 920 million. Because before you can understand what happened to silver in January 2026, you have to understand who has been sitting at the center of this market for the last 2 decades. And you have to understand that they already admitted in federal court to the exact crime that people are now alleging they committed again. JP Morgan Chase paid $920 million in 2020, a record fine, as part of a deferred prosecution agreement with the United States Department of Justice for systematically manipulating the gold and silver futures markets between 2008 and 2016. 8 years. Not a rogue trader, not a one-time glitch. 8 years of deliberate, coordinated spoofing, placing massive fake orders to move prices in a direction that benefited their own positions, then canceling those orders before they could be filled. 2 of their traders, Michael Nowak and Greg Smith, received federal prison sentences in 2023 for their roles in the scheme. And JP Morgan was not alone. 7 other banks paid their share of what ultimately totaled $1.27 billion in fines across enforcement actions spanning from 2016 all the way through 2025. Scotiabank paid $127.5 million. HSBC paid $76.6 million. Deutsche Bank paid $75.5 million. Bank of America paid $25 million. UBS paid $20 million. Goldman Sachs paid $20 million. Morgan Stanley paid $1.5 million. That is not a conspiracy theory. That is public record. That is documented by the United States Department of Justice, the CFTC, and a string of federal court filings that you can read tonight. So when people say silver is manipulated, they are not wearing tinfoil hats. They are citing court documents. Now here is where it starts to get interesting. Because by late 2025, the narrative around JP Morgan's silver position had completely flipped. Not reduced, not hedged, flipped. Market data aggregators and CFTC positioning reports indicate that as of late December 2025, JP Morgan held an estimated combined silver position of approximately 713 million ounces, consisting of roughly 196 million ounces in COMEX proprietary and brokerage accounts, and approximately 517 million ounces held in SLV ETF custody. The same bank that was the most notorious silver short seller in the history of the market had apparently repositioned itself on the other side of the trade entirely. And the timing of that flip is not something you can look at without raising an eyebrow, because it happened right before silver did something it had never done in recorded history. Silver hit $121.67 per troy ounce on January 29th, 2026, an all-time nominal high. Not a 40-year high, not a decade high, the highest price at which this metal had ever traded in the history of organized commodity markets. Silver had doubled across all of 2025. Then in January 2026 alone, it surged another 65%. It broke through $50, then $70, then $100, a psychological milestone it had never breached before, then kept moving. By January 26th, CNBC was reporting on silver's historic surge in real time. By January 29th, it peaked at $121.67. And then, within 30 hours, it crashed 38%. So if the shortage is this severe, if physical silver is disappearing from COMEX warehouses at volumes the exchange has never processed in 15 consecutive months of record delivery, why did the price collapse 38% in 30 hours at the exact moment retail investors were most exposed? Hold that question, because the answer involves a name you already know. and we are going to come back to it with specific data that was filed in exchange records. First, understand what was happening in the physical market at the same time the paper price was being obliterated. On January 1st, 2026, the same day China implemented its silver export control regime, physical bullion dealers in Japan and the United Arab Emirates were selling silver for approximately $130 per ounce. The COMEX paper price at that exact moment was showing $72 per ounce, an 80% premium for physical metal over the official exchange price, not in some obscure back alley market. In the world's most sophisticated bullion trading hubs, Tokyo and Dubai, the actual price for an actual bar of silver was 80% higher than what your brokerage screen was showing you. Physical silver inventories across Asia had effectively vanished. Queues formed outside bullion dealers in China, Japan, and Taiwan. Buyers in Shanghai were offering $8 to $10 per ounce above COMEX prices just to secure metal within their own borders. Indian buyers were offering $5 premiums. And the spread did not compress the way spreads are supposed to compress in a functioning arbitrage market, because the metal that should have flowed from west to east to close that spread simply was not available to move. In a moment, I'm going to walk you through a specific sequence of events that unfolded on January 30th, 2026, in the space of approximately 4 hours, that should be the most reported financial story of the year. It is not. And the silence around it is arguably more important than the events themselves. But before we get there, you need to understand what China actually did on January 1st and why it was not reported as the seismic market event it actually was. China controls an estimated 60% to 70% of global refined silver exports. Not mining, refining. The finished, deliverable product that feeds industrial supply chains. On January 1st, 2026, Beijing reclassified silver from an ordinary commodity to a strategic material, placing it in the same regulatory category as rare earth elements. From that date forward, silver exports require government licenses. Those licenses are granted only to 44 approved firms. To qualify, a firm must demonstrate annual refined output of at least 80 tons, credit lines above $30 million, and pass scrutiny at the national level. China had exported more than 4,000 tons of silver in just the first 11 months of 2025, while importing only 220 tons. They were a massive net exporter. Then they turned the tap off. And they did it while their own domestic buyers were paying $8 to $10 per ounce, above world prices to keep metal inside the country. The question you are supposed to ask, but are apparently not supposed to ask too loudly, is what do they know about the coming value of this metal that led them to reclassify it as a strategic asset at the same moment they were hoarding it domestically? Elon Musk commented publicly on the export restrictions. His exact words were, "This is not good. Silver is needed in many industrial processes." The man behind Tesla and SpaceX, companies that depend heavily on silver for EV battery contacts and satellite semiconductors, was registering alarm in plain public view. Nobody was listening. Now let's come back to the paper versus physical contradiction, because this is the structural heart of everything else in this story. Paper says crash. Physical says something completely different, and both cannot be right at the same time. The COMEX silver futures market operates on a foundational assumption that is held for decades. Most contract holders will never ask for physical delivery. They will roll their contracts, take cash settlement, and trust that the metal backing those contracts actually exists somewhere in an approved vault. That assumption generates a ratio, the ratio of paper claims to physical metal, that the entire pricing system depends on. In 2026, that ratio is estimated at approximately 350 paper contracts for every 1 physical ounce of deliverable silver, 350 to 1. And while that ratio has existed in various forms for years, what changed in 2026 is that investors stopped behaving the way the system needs them to behave. They started actually asking for delivery. For 15 consecutive months through early 2026, physical silver has been leaving COMEX warehouses at volumes the exchange had never processed. December 2025 produced 65 million ounces in a single month, a record. January 2026 followed with 49.4 million ounces of physical delivery, more than 7 times what January 2024 had generated. All of 2025 combined settled 474 million ounces in physical delivery compared to 203 million ounces in 2024. The number more than doubled in a single calendar year. And the category of silver that matters most, registered silver, the metal specifically warranted and available for exchange delivery, had fallen approximately 75% from its 2020 peak by early 2026. As of February 2026, COMEX registered silver available for delivery stood at 103 million ounces, against total open interest of 429 million ounces. That is a coverage ratio of 24%. There are roughly 4 paper claims for every 1 actual deliverable ounce. Historical delivery analysis flags operational crises when delivery demands exceed 25% of open contracts. The system was already sitting at the edge of that threshold before March even began. But here is the question that nobody in mainstream finance will ask directly. Why was the Federal Reserve Bank of New York quietly injecting tens of billions of dollars into banks starting as early as October 2025? And why did it deliver $17 billion in a single repo operation on December 26th, Christmas morning, to an unnamed institution? The Fed changed its standing overnight repo policy on December 10th, removing the aggregate operational limit entirely. Their official statement used the phrase unlimited cash. The standing overnight repo operations would no longer have an aggregate operational limit. Why does a central bank go to unlimited cash provision in December 2025? And who needed that December 26th lifeline? Which institution was drowning quietly enough that it required a $17 billion Christmas morning rescue? And why has nobody been told which institution received it? Former banking regulator Bill Black, who uncovered the savings and loan scandals, noted that these kinds of cash infusions typically happen about every 5 years. The preceding period had gone 5 years and 3 months with virtually no repo deals of this scale. Then came multi-billion-dollar infusions roughly every third business day starting in the fall of 2025. Someone was under pressure. Systemic, serious, existential pressure. And the timeline places that pressure squarely in the same window as silver's most violent price movements in 46 years. Now we get to January 30th, 2026. The day of the crash. The sequence matters, so stay with me. Silver had peaked at 121/67 on January 29th. The following morning, as the market opened and began to roll over, 3 things happened in tight sequence. The London Metal Exchange reported a pre-market glitch that delayed the start of electronic trading, at exactly the moment when the London Open would have provided liquidity support for long positions. HSBC, one of the banks that paid fines in the silver manipulation cases, simultaneously reported its own systems down. And the CME Group's COMEX division announced it was hiking margin requirements on silver futures, forcing every leveraged long trader in the market to either post substantially more capital immediately or liquidate their position. The margin increase came as liquidity was already thinning. The forced selling from traders who could not meet the new requirements hit a market with 2 of its primary liquidity providers suddenly offline. Silver dropped from $121 to approximately $75 in under 30 hours, a 38% collapse, the worst single-day decline for silver since 1980, and then the COMEX delivery data came out. JP Morgan issued 6 and 33 February silver contracts at a price of $78.29, near the precise intraday low of the crash. Issuing contracts at COMEX means being on the short side. It means selling silver into delivery, except that JP Morgan had reportedly spent the prior 12 months positioning itself massively long. So what happened here, according to analysts who tracked the delivery data, is this. JP Morgan appears to have used the chaos of January 30th, the glitches, the margin hikes, the forced liquidations, to close out a remaining short exposure at the exact market bottom. The same bank, the same market, the same playbook. The only difference is that in 2020, they paid $920 million and went to federal court. In 2026, the trade settled itself in 30 hours of price discovery that most retail investors are still trying to understand. This is where you need to hear the other side of the argument, because this channel does not present one-sided analysis and call it research. The Bank for International Settlements, the central bank of central banks, published a direct examination of the silver crash in its March 2026 quarterly review. Their conclusion was not manipulation. Their conclusion was mechanics. Retail investors, they argued, created bubble conditions in silver through ETF buying that was never matched by institutional commitment. Leveraged silver ETF funds rebalance daily to maintain fixed leverage ratios. When prices rise, they buy futures to restore their target leverage. When prices fall, they sell. That predictable, momentum-driven rebalancing creates feedback loops that intensify price trends in both directions. The leverage rebalancing multiplier in silver ETFs doubled over the course of 2025. The share of leveraged ETFs in the silver market grew proportionally. When prices reversed in late January, the daily rebalancing mechanics of those funds automatically amplified the selling. Margin calls on futures positions cascaded across the system as exchanges raised requirements. Silver ETF premiums over net asset value, which had been elevated throughout the rally, compressed rapidly and flipped into discounts, consistent with one-sided retail panic selling. The BIS framed this as the market functioning exactly as designed. Institutional investors, they noted, had maintained stable positions or trimmed exposure during the rally. It was smaller retail participants, the non-reportables in CFTC terminology, who were net long silver futures going into the correction. As prices fell and margin requirements rose, those participants were the ones forced to reduce positions fastest. Dealers stepped in to provide liquidity by cutting their own short positions. The BIS argument is internally consistent and data supported. It is also the explanation that requires no one to have done anything illegal. Whether you find that comforting or suspicious probably depends on what you think about the $920 million that was paid 4 years ago. Everything I've shown you about COMEX delivery stress so far assumes the registered inventory holds at approximately the levels reported in February 2026. It doesn't. Because what happened on March 3, 2026 changes the entire timeline. On that single day, silver crashed 15.8% intraday from $96.66 to $81.40, while 4,540 COMEX contracts, representing 43.1% of all standing delivery contracts, were fulfilled on day one of the delivery period, the most extreme physical delivery concentration ever recorded at the exchange. Not a record for a delivery month, not a record for a quarter, the most extreme first-day delivery concentration in the exchange's history, and it happened during a price crash, physical delivery surging to record levels, during a paper price collapse, if supply was freely available, if the system had adequate metal to meet demand. You don't see that concentration. You don't see 43.1% of all standing contracts physically settled on a single day during a 15.8% intraday price drop. Those two data points cannot coexist in a healthy market. At least one of them is telling you something the other is trying to hide. The Silver Institute, not a newsletter, not a Reddit forum, the industry's primary research body relying on Metals Focus, the most respected precious metals consultancy in London, published its 2026 outlook on February 10th. Their findings were not fringe analysis. The silver market is forecast to remain in deficit for the sixth consecutive year in 2026. The projected shortfall is 67 million ounces. The cumulative supply deficit since 2021 is estimated at approximately 820 million ounces, nearly an entire year of global mine production simply consumed and gone. Total global silver supply in 2026 is forecast to reach a decade high of 1.05 billion ounces, with mine production rising 1% to 820 million ounces. And still, the market runs short. Industrial fabrication is forecast at 650 million ounces, down 2% from 2025, but still enormous. Physical investment demand is forecast to rise 20% to 227 million ounces, a 3-year high. Global ETP holdings stood at an estimated 1.31 billion ounces as of February 2026. The industrial demand structure underneath silver is not speculative. It is engineering. Every photovoltaic cell in every solar panel contains approximately 111 milligrams of silver, not as a substitute for something cheaper, but as the most electrically conductive element on the periodic table performing a function nothing else can perform as efficiently. By 2025, the solar industry alone was consuming between 200 and 250 million ounces of silver annually. Electric vehicles consume an additional 40 to 60 million ounces per year. Data centers, 5G infrastructure, AI semiconductors, medical devices, each adds to a demand base that did not exist at scale a decade ago. Samsung has patented EV battery technology requiring approximately 1 kilogram of silver per vehicle. China's EV sector represented approximately 43% of global auto sales by Q1 2025. Each Tomahawk missile contains roughly 500 ounces of silver, worth approximately $40,000 at current prices. Nuclear reactor control rods lock in silver consumption for 40-year operating lifetimes. And here is the fact that separates silver from gold in every fundamental analysis. The silver consumed in a solar panel cannot be economically recovered. Recovery costs from industrial applications run $150 to $200 per ounce, often exceeding the market price of the metal itself. That silver is gone. Every ounce that goes into a panel, a battery, a missile, or a semiconductor is permanently removed from the above-ground supply pool. It will never come back. Meanwhile, European banks quietly started doing something unusual at the start of 2026. Basel III capital rules, which came into full effect on January 1st, forced European banks to reassess their unallocated paper silver holdings and begin replacing them with allocated physical metal to meet new liquidity requirements. Unallocated silver, the form in which most London silver has historically been held, is essentially a promise backed by pooled inventory of uncertain composition. Basel III said that promise wasn't good enough anymore. Banks scrambled to source physical bars. The Sprott Physical Silver Trust doubled its capital raise program in January 2026 to $2 billion, enough at then current prices to acquire approximately 18 million ounces of physical silver, representing roughly 16% of total COMEX registered inventory in a single institutional move. That is not a retail trader making a bet. That is a sophisticated institutional vehicle making a $2 billion statement about what they believe physical silver is worth relative to the paper claims against it. And behind it all, the flow of metal tells the most honest story of any. COMEX registered silver bars, serialized, hallmarked, institutionally documented objects, are not raw feedstock. Industrial users in China and India do not source silver from COMEX vaults. They have long-term offtake agreements with mines. They operate on forward contracts designed precisely to insulate their production schedules from spot volatility. The entities standing for delivery at COMEX are, almost by definition, not solar panel manufacturers in Anhui province. They are sovereign adjacent capital, institutional funds, entities that deal in 1,000-ounce bars as stores of value, and who have collectively decided, across 15 consecutive months, that they would rather hold the physical bar than trust the paper receipt. Trucks are backing up to vaults in northern New Jersey. Pallets of serialized 1,000-ounce bars are being loaded and moved. JP Morgan was reported to be shipping metal eastward at premiums of $10 per ounce above COMEX prices, with the VAT tax falling on the Asian recipient. And buyers absorbed both the premium and the tax willingly, repeatedly, because they valued the physical bar more than they valued any paper substitute. Bank forecasts for silver in 2026 sit between $58 and $70 per troy ounce. JP Morgan, Metals Focus, Saxo Bank, and UBS have all published figures in that range. Trading Economics global macro models project a 12-month target of approximately $91 per ounce. The silver market is currently trading in the $67 to $70 range after the crash from its January all-time high. As of March 20th, 2026, the SLV ETF closed at $61.52, down 4.89% on the day, on volume of 56.9 million shares. The spot silver price reached a session low of $67.60 on that same day, down 7.13% from the prior session, according to Trading Economics. Silver's annual price history shows a 2026 range of $71.59 to $85.10 through the current reporting period, still representing a gain of over 104% versus 1 year ago. The metal that mainstream forecasters said would peak around $58 is currently trading more than 15% above those forecasts after a 44% crash from its all-time high. The market that was supposed to be calm is anything but calm. Here's what separates the people watching this video from the 99% who are not. You have now seen the actual delivery data. You have seen the 15 consecutive months of record physical withdrawals. You have seen the 75% collapse in COMEX registered inventory from its 2020 peak. You have seen the $1.27 billion in fines paid by 8 banks for the exact crime now being alleged again. You have seen the 80% physical-to-paper premium in Tokyo and Dubai. You have seen China reclassify silver as a strategic material with the same regulatory language it used for rare earths. You have seen Basel III forcing European banks to scramble for physical bars. You have seen the Fed remove aggregate limits on overnight repo operations in December 2025. You have seen 633 JP Morgan contracts settle at 78.829, the near exact intraday low of the crash. You have seen 43.1% first-day physical delivery on March 3rd during a 15.8% intraday crash. Most people will read a headline about silver's decline from $121 and conclude the bubble burst. They'll absorb the mainstream narrative, park the information under volatile commodities, and move on. You now know that the delivery data, the physical premiums, the COMEX inventory charts, and the institutional positioning tell a structurally different story from the one being broadcast. That does not mean you should act impulsively. It means you should watch what happens in the next delivery cycle with eyes that are calibrated to the right variables. Not the paper price in isolation, but the ratio between registered inventory and open interest, the trajectory of physical deliveries, and whether the premium between paper and physical continues to exist or begins to compress. If this kind of forensic analysis is what you want more of, then joining this channel is how you get it. Hit subscribe, not because this video ended, but because the story hasn't. The next delivery cycle, the next Fed repo operation, the next COMEX inventory report, each one of those is a data point in a sequence that is still being written. Be in the room when the next chapter lands. Drop the comment OG John AG 2.0 right now, not to prove you sat through a YouTube video, but to mark this moment as the one where you stopped reading silver headlines and started reading silver data. There are very few people in this market who know the difference. That number just went up by 1. This channel runs on one principle that will never change. Invest with logic, not with noise. The price is wrong. The question is, for how long?